Tips for achieving financial security. Hi there, it's Luigi and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you enjoy watching our videos, feel free to like, subscribe, and hit that notification bell so you get updated whenever we upload a new video. In today's video, we are going to share with you some tips for achieving financial security. So if you want to learn these techniques, then keep on watching. Almost all of the recent studies on personal finance indicate that most people are unable to establish financial stability, particularly in their retirement years. This simply emphasizes the reality that gaining financial stability is a difficult process that demands careful preparation and execution. To be sure, various people define financial stability differently, but let's keep it simple. Financial security is having enough financial assets to pay for your needs, emergencies, and retirement without worrying about running out. Here are some tips to help you achieve financial security. 1. Begin as soon as possible. It is evident that it is preferable to begin saving from a young age, but it is never too late to begin, even if you're nearing retirement, because every cent saved helps to pay for your expenses. If you saved $200 per month for 40 years at a 5% interest rate, you will have saved far more than someone who saves at the same rate for 10 years. However, the amount saved over a shorter period of time can go a long way toward covering expenditures during retirement. Also bear in mind that as you approach closer to retirement, other aspects of financial planning, like asset allocation, will become more significant. This is because your risk tolerance lowers as the number of years you have to recover any losses reduces. 2. View savings deposits as a bill. Saving on a daily basis can be difficult, especially given the numerous recurring expenditures we all face, not to mention the attractive commercial products that encourage us to spend our disposable income. You may avoid this temptation by approaching your retirement savings as a periodic expenditure, comparable to rent, mortgage, or auto loan payments. This is made much easier if the sum is deducted automatically from your paycheck by your employer. Alternatively, you can have your pay deposited directly into a bank or savings account. You can also have the selected savings amount credited to the retirement savings account automatically on the same day the payment is credited. 3. Save in a tax-deferred account. Contributing money set aside for retirement to a tax-deferred retirement account discourages you from spending it on impulse, since you will suffer tax repercussions and penalties. For example, any money received from a conventional retirement plan may be liable to income taxes in the year of distribution. And if you are under the age of 59 at the time of distribution, the amount may be subject to a 10% early distribution penalty. Consider whether you can raise the amount you save in tax-deferred accounts if you have adequate income. Consider if you can afford to contribute to an individual retirement account or IRA in addition to an employer-sponsored retirement plan, and whether the IRA should be a Roth IRA or a regular IRA. 4. Diversify your investment portfolio. The classic saying is that we shouldn't put all of our eggs in one basket, and that also applies to retirement savings. Investing all of your funds into one type of investment raises the danger of losing all of your capital and may reduce your return on investment, or ROI. As a result, asset allocation is a critical component of managing your retirement funds. Proper asset allocation considers aspects such as the following: your age. This is frequently mirrored in the aggressiveness of your portfolio, which will take more risks when you're younger and less as you approach closer to retirement. Your risk appetite. This helps to guarantee that any losses occur at a period when the losses can still be recovered. Whether you want your assets to expand or generate income. Consider all potential expenses. Some of us make the error of not factoring in medical and dental bills, long-term care, and income taxes when budgeting for retirement. Make a note of all the costs you may spend throughout your retirement years when determining how much you need to save for retirement. This will assist you in making accurate estimates and planning accordingly. 6. Retirement savings are required. Saving a lot of money is fantastic, but the benefits are diminished or even erased if you have to rely on high-interest loans to cover your living needs. Plan ahead of time and stick to a budget. To guarantee your disposable income is computed correctly, include your retirement savings within your scheduled regular costs. 7. Review your portfolio on a regular basis. As you approach retirement and your financial demands, costs, and risk tolerance change, you must undertake strategic asset allocation on your portfolio to allow for any necessary modifications. This will assist you in ensuring that your retirement planning is on track. 8. Evaluate your expenses. If your lifestyle, income, or fiscal obligations have changed, it may be a good idea to review your financial profile and to make any necessary modifications to modify the amounts you contribute to your retirement nest egg. A re-evaluation of your income, spending, and financial commitments can help you evaluate if you should increase or decrease the amount you save on a regular basis. 9. Think about your spouse. Consider whether your partner is also saving and whether some expenditures may be split throughout your retirement years if you're married. If your spouse hasn't been saving, you should consider if your retirement resources can meet not only your own, but also your spouse's costs. 10. Consult a financial planner. Unless you have prior expertise with financial planning and portfolio management, you might need to hire the services of an experienced and trained financial planner. Choosing the proper one for you will be one of the most significant decisions you will make. How much money do you need to be financially secure? This is determined by your age, income requirements, and financial goals. However, in general, the 4% rule is a good indicator of financial security. In other words, if you can securely remove 4% of your investment accounts each year and never run out of money, you are probably financially secure. How can you secure your financial future? The following are the finest approaches to safeguard your financial security. Continue living substantially below your means. When you live within your means, you have the ability to deal with an unexpected vehicle repair or medical cost, save for retirement, and support your goals, whether they are to build a nice fancy home or start an Etsy shop. A reasonable rule of thumb is to live on at least 15% less than your income. Being cautious when it comes to investing. Understanding your risk tolerance is a key component of determining which investment to make. When you make an investment, you might profit or lose money due to the rise and fall of the financial markets, so it is important to be careful when investing. Creating many revenue sources. Having several revenue streams helps a person to have a variety of cash flow sources. This puts you in a better position to be ready if one of your income sources fails. How can I become financially independent in 5 years? Consider the following strategies to achieve financial independence in 5 years. Determine your starting point for revenue and costs. Reduce your spending as much as possible. Pay off as much debt as you can. Increase your earnings by taking on a second job or starting a side company. Increase your monthly savings rate to 75% or higher. Prioritize growing assets while investing. What we've covered here are just a few of the aspects that might influence the effectiveness of your retirement plan. So make sure you keep these things in mind, but also do your own research. And that's it for this video. If you enjoyed it, don't forget to like, subscribe, and hit that notification bell. Thank you so much for tuning in to Catapult Capitalism, and we'll see you later.